Good morning, everyone. Right now, I'm here to present my topic that the project I did for the minor in AI program by IT Roper. And in the domain I chose, that is AI for market trend analysis, and it was supervised by Dr. Niranjan Deshpande. And the project that I did is titled Unsupervised Regime Analysis, particularly for the equity biotechnology market using a multi-model approach and representation learning as the core algorithm. So let's get into it. And the challenge why I took biotech market is that it behaves fundamentally different in most of the times, different from the general market, that it is really highly volatile and behaves differently from the beta of the general market. And the data associated with it for a multi-model fusion is really sparse and scattered all across and not even available at some point. And the behavior or the returns or the performance of the particular biotech stock market depends not only on the general market features and the revenue or the stock or the market performance of the stock, but extra financial features such as the clinical dependencies, such as, let's say, for a company that specializes in, for example, in the COVID vaccine, and during the COVID time, let's say the mRNA technology, and they were specifically well posed to make huge profits during that public health emergency. They could be capitalized off on that. And then there is regulatory changes, let's say government impose some regulatory changes, and a certain company A could not works in a space for a specific product that could not operate in that regulatory environment, and the opposite company takes over as the market leader. And then of course there is the clinical trials, which is the main focus that we are focusing on here as the extra modality from the stock features for the market features of these stocks. And this is the number of products, that is the drugs that in a company's clinical trial pipeline, that is phase 1, phase 2, phase 3, and phase 4, and the concentration of the count data between the phase 1 and 2, which is most common in all the companies, were compared to the phase 3 and 4, which is the defining factor of the company's success. And if, let's say, a certain company has some of the candidates graduated from the phase 2 to get approval to phase 3 and phase 4, the valuation and the valuation of the company could shoot up overnight, regardless of the market position or the finance of that company, financial status of the company, which is, and these kind of characteristics of the biotech market differentiate it from the rest of the market. So how do we do this? We first collected the pipeline. We collected the data. We collected the data is that we collect, like, for the both of the modalities. Like for the stock modalities, we collected through the Y Finance some of the stock features for the past 24 months. That is for a specific time period. That is 2021 to 2023. February, the 24 months in between. And then we collected, we took that because the latest clinical trial data of these companies available on the clinicaltrials.gov public domain was on the February month of 2023, and we wanted the stock features to be aligned with the clinical features temporarily. And then we performed feature engineering, and the issues we faced during the feature engineering was that it was really sparse, and the data did not fit any the normal statistical distributions. And for the missing data in the stock features, that is companies that were pre-IPO and companies that dropped off the index during the time span that we took, we filled it. We, rather than cutting them off, slicing them off, and or filling them with arbitrary median or zero null values, what we did was that we employed a masking strategy where the downstream models considered whether to take these null values into their calculation or not, and thus provides a consistent 3D tensor shape for the models, while also learning the non while also ignoring the non-significant values of these stock features. And the clinical phase signals, what we did was that we did global scaling. We did Z-score normalization globally, and scaling also we did. And then for the stock features, we did the normalization log 1xp normalization only for the volume feature, because it was we did not want the model to be biased positively to the highly liquid and high volume trading stocks. We wanted the model to learn equally from both the clinical and stock features without overweighting one or the other. So let's now we have a processed set of stock data and clinical data. Let's keep the clinical data aside for a moment. And what we did was that we trained an LSTM autoencoder and to create a encoder and decoder architecture. What we do so that the resulting 32 vector 32 dimensional vector for each ticker is well poised to understand the whole history of a particular stock for the past 24 months pertaining to the market features only. So essentially, this acts as a summarizer of the market features for how these particular stock performed for the past 24 months from a stock or market point of view into a single vector. So how we did this was we took an LSTM, the input layer, which is 50 by 755 into 5. That is the 50 tickers, 50 filtered tickers, 50 tickers that is across the within the biotech market, but across market cap, large cap, mid cap, small cap for an equal representation of all the scenarios. And then, of course, the 755 dimension comes from the 755 days, that is the 24 months that we took for the each timestamp. And then the 5 is the number of features, the price features that we pulled from the Y Finance for all these timestamps per ticker. And then we passed it through two layers of encoders, each of 32 dimensions. And then we performed a means mask aware mean pooling. And the mean polling is when instead of taking the last hidden state to predict a value for the each of the stock features, what we did is that we took the mean of all these states, hidden states, and so that the final embedding has a history of the entire history of the stock features rather than the near the terminal features that is encoded specifically in the last hidden state. So and a decoder was employed in the same architecture but in the reverse to so that the final output and in it was trained using a loss function that is also this mask aware uh, and this binary mask that has ones and zeros, the ones and only considers those values during the training that has the true mask values, that is one values, and ignores the values which has zero timestamps. And yeah, and the result we did 100 epochs of training, and we use Adam optimizer and a learning rate of 10 raised to minus 3. These hyperparameters and batch size 8 tickers were processed at once. And we took this for these hyperparameters after several training debuts. And then the results were we can see from the graph here that the orange line from the orange line, which is the reconstructed model, it smooths out the uh, highs and lows really good, and is overall capable to is capable of learning the entire model, how a particular stock behaves during this 24 months period. And so now that we have a good model that is able to learn how a stock behaves across a particular time with respect to the market only. And we did the visualization with the PCA. We saw that a great cluster is here with a lot of outliers that perform differently from the other stocks. And then there are pairs of companies like the NBAX and the ALNY, which that uh, actually perform in the same market, such as veterinary medicine. And the model was able to understand that they are related much better than the others. And so now that we have the 32 vector embedding for each stock, we combine it with their respective clinical data that we fetched from that we fetched earlier and then processed. And after the combined data array is passed on to a PC, a principal component analysis model. We trained on number of components too, and we took the so after the combination we visualize we what we did was that we took the scalar scores of the PC1 scores associated with the highest variance, that is the PC1, that is the highest variance principal component. We took the scores associated with that for each of the ticker, and then we z score normalized them and employed a ranking based on these z score normalized PC1 scores. And intuitively we set cutoffs to classify them these stocks into regimes based on that metric. The top 30 percentile of were classified as buy stocks, and then the bottom 30 percentile was classified into the regime of sell, and the middle 40 percentile was kept in the whole bucket, the whole regime. We don't do anything with that. And so from the PCA we can see that the regime classification capability increased drastically when two of the complementary but orthogonal features were combined. We can see that even though the ticker embeddings do show some cluster separation, it was greatly enhanced when we combined the clinical features with it. So, and we can see a separate cluster for buy here, a really different cluster for of with high variance in the cell here, and in the bottom right corner we have the hold regime here. And this proves that using two modalities for this particular for learning this particular market, that is the biotech market stock, using this autoencoder structure combined with the PCM model, using two different modalities yields better result than using one single modality. That is the stock modality that is usually used, what is used in the uh, legacy ML models for particular stock market analytics tasks. And so we know that the PCA performed well, our LSTM performed well, fairly better. And then there is when we can combine both, there was significant improvement. And now we know the technical aspects and of it, but how does this framework as a whole perform when introduced into the market, for which we did the for backtest, what we did was that at the beginning we compute for all the we pass all the tickers through the framework and we get the ranks finally. And from the buy bucket we assign equal weights of capital to all the just the companies in the buy bucket. We hold those for 1 month. We recalculate the price features, the stock features and everything, and then we pass with the new values of the features. We pass through the new values through the framework again. We rebalance, we recalculate the rank, and then get the new buy bucket. And then we kind of repeat it again and again until 24 months, that the time period we starts. And we calculate the returns we get. We calculate the returns we get, the losses, the volatility and everything. And and from this results we can see that from this backtest equity curve we can see that the blue line, which is the profits that we got from the model, and the orange line is a baseline that we also calculated in parallel with where the strategy was to buy all the stocks in equal weight as a to compare against the baseline. And we see that our model performed 21.8 percentage better than the baseline. It We can see that at the beginning it performs good, but when the general markets was down, it performed worse than the baseline. But when the market picked up, it performed significantly better than the baseline, ultimately resulting in a higher reward from the initial amount we put into both the models. So But the so at the we got 21.8 percentage, around estimated 21.8 percentage, better than the baseline model reward. And then, but it came with a significant risk, like 39.6 percentage volatility, analyzed volatility, and the drawdown was also worse than the baseline model, and due to which the Sharpe value was also near to or comparatively lesser, a bit lesser than the baseline model. And during each rebalancing, this is 30 months, the buy bucket did not change really huge, really bad, because the regime, this is where we calculate the regime persistence. The buy bucket almost always had the same composition of stocks. But the model really does not bet on a single two or three stocks that performed luckily well. From the waterfall analysis, we can see that the overall returns were contributed by, even though majorly contributed by two or three stocks, a lot of other stocks also contributed significantly to the overall returns. And the monthly return contribution, when we analyze here, we can see that the model successfully identified a good opportunity that created an extremely high reward, that produced an extremely high reward that the baseline model could not identify. That was the second last month during our 24-month times period. The MTGL and SMMT produced the highest returns from the if we take the overall contribution across the 24 months. And the model could uh, classify them into a regime that we needed to buy, and that ultimately resulted in very high rewards, increasing the total reward that we got, that we earlier discussed, compared to the baseline. And the baseline completely missed this. So uh, so the model, what we did had was a better approach than the baseline model. So we know that it got higher returns, but albeit with higher volatility and risk. But to test the statistical significance of this, or it was just a random luck, we did the student t-test and the ANOVA also. But as usual, as expected, it the values are really worse, like 0.48 for student t-test p-value, and the p-value for ANOVA was 0.41, and this is way higher than the 0.05 cutoff that we actually take to test the significance. And but this is not, but these tests do not actually show are not a good metric to judge this type of models, where it is that it works perfectly well for the perfect intended universe, that is the biotech universe, which is highly volatile and sparse. So the student t-test and ANOVA and all the classical tests, what they do is that they penalize volatility, that is the standard deviation, both in the positive and the negative side. They don't really care about whether the volatility was to the upside, that is the returns, or the losses. And in the models and the models that function like this for this specific market is not well poised to be judged by these kind of statistical tests, for which we did the Sortino ratio, which is the apt one for judging the as a clear for evaluating this model, that is compared to the Sharpe ratio. What Sharpe It is a modification of the Sharpe ratio. What the Sharpe ratio is that it takes all the analyzed returns divided by the analyzed volatility, both to the positive, that is to the reward side, and the loss side. But the Sortino ratio ignores the reward, the positive side of the volatility, because it is expected in the biotech market. And so it only cares about where the investor was wrong, or where a particular decision led to the loss of money, that is to the negative side of the risk. And from here, it is very clear that the Sortino ratio is double the Sharpe ratio, which is very well what we needed to show that the model works in this setting that we performed. And the Sortino ratio was around 1.3 and the Sharpe ratio was 0.65. So from these, what we can infer, and from this rolling Sortino and versus Sharpe ratio graph also, well, during the evaluation, we created this plot. We see that the green line, that is the Sortino ratio, is constantly above the Sharpe ratio. We see that the volatility, the high volatility that we got by investing following this model was mostly due to the upside volatility, which is not bad, which does not hurt the investor. So it is expected in this market, and this volatility happens because the model was successful in finding out latent opportunities that other models could not, and capitalize off them, like we discussed in the second last month, MDDG and those two stocks, that proportionally disparate positive returns we got by investing in these models. And these are also deviations. So the standard statisticals, including the Sharp, punish them, but that is not ideal. So that is why we are using the Sortino ratio to evaluate this model, and which is and for which we got a value of estimated 1.3, which is desirable for this model. So what is the conclusion? Conclusion, we set out to prove three objectives. What we did was that two objectives. What we did was that we wanted to say that for a niche market like biotech, not a niche market, like a peculiar idiosyncratic market that does not generalize well to the no, normal other sectors of the stock market. We wanted to combine two features and prove two modalities, that is the clinical and stock data, to prove that combining this early rather than separately training them and then using an ensemble technique. What we did is we early combine the features using the PCA, and then these combining multi-model approach is better. And then the what we did is, like, we tested the back testing rather than just relying on these model evaluation metrics. We simulated how the model performs, and we saw that the Sortino ratio was the best to evaluate this kind of function. And the main thing was that we can derive from these metrics of the high Sortino ratio, low shock value, high returns, and high returns and high volatility, is that this model that we just created functions more like a venture capitalist who invests in a lot of companies and hoping that two or three of them might result in a disparate positive returns, and then exit in with a net positive than the amount of invested across all these companies, rather than like a fund manager that is who is more restricted by the sharp values, where they are managing a lot of people's money across a large customer base. And it is really risk tolerant rather than being risk averse, which is the like a moonshot regime identifier. And that was what is expected of this market, what a model that is meant for a regime identification that would help scientists or maybe researchers or analytics or analysts or investors in identifying clusters of companies that within their own judgment, that is to invest or make decisions on whether to invest or not, rather than being just a predictor of price features. So that objectives of the project is being completed. That is proven in this with the metrics that we got. And of course, this is not a production ready model. This is a research based within a short time. So we created this model, and with the help of Dr. Niranjan. And yeah, this to as a future work, if we were to carry out, we could increase the amount of tickers, amount of stock into 300, maybe 500, and then get multiple time points of clinical data and combine them with the multiple span durations of the stock data to create a different kind of batches for the training of this model. And we can use different models itself, such as moving from LSTM to attention based models, such as temporal fusion transformer models, or Yeah, and then require rigorous testing before to be used as a financial advisor, actual financial advisor. This is a proof of concept, and as a proof of concept, it performs particularly well. And yeah, was my project. What I did. Thank you.